That's a good point. I guess I'm glad I built my house about 2 years ago instead of today. Saved some money on that wood. Well, while we're talking about inflation, let's talk about bonds and the importance of them in a portfolio. They've been a diversifier. You know, the old 60-40 portfolio. Over the last about decade and a half, they've had a negative correlation to stocks. So stocks go down, your bonds go up. It's given birth to things like risk parity. But when inflation runs a little higher, the correlation between those two assets flips positive. And you've seen that more recently, kind of in the last 3 months. The 3-month rolling average of that correlation is flipped positive. So you've seen days when your stocks go down, your bonds go down, your stocks go up, your bonds go up. So what's an investor supposed to do? I don't think the answer is no bonds. Perhaps they just don't need to have as much duration as they've used over the last 10 to 15 years. Maybe not in the, like you said, in the long run, it might be time to go back to those longer duration securities. But I think in the short run, you just don't need as much duration in your bond portfolio while we get through this patch of higher inflation and maybe higher interest rates. What are your thoughts there?
I think that's right. As the market is focused on inflation here in the short term, and like we've talked about, we don't know how long that period is going to last. Bonds may wind up being a dangerous asset to hold. We've seen rates on the 10-year back up about 100 basis points from their crisis lows. They seem to have found a level around 1.6%. It seems like market expectations certainly are for higher rates, really across the the belly and the longer portion of the curve, certainly at least in the short term. And so the question is, how do you diversify a portfolio? We've actually been wrestling with this question for well over a decade, because our view on fixed income. I'd say 10 years ago it was probably wrong, because we've been short duration for about as long as I can remember. We've been right over the past year or so. But it doesn't make up for the prior decade. But our view is that from an expected return perspective, right now, our expected return on the Barclays aggregate is about 1.5%. And so if you have an expected return, if you have an actuarial expected return, if you have a spend, if you're an endowment or foundation, you are not going to achieve your objectives through high quality fixed income. 1.5 is simply not going to get you there. And cash is, and cash, while it's stable, it's even worse from an expected return perspective. And so our view has actually been very, very bullish on equities, because the Fed, their playbook is really focused in a way on asset prices. It's interesting when we think about inflation. I think there's something that we really need to think about. What is inflation? I think there's lots of different types of inflation. We tend to be focused on CPI inflation, but what is CPI inflation? CPI is effectively the wage basket it is the price basket of an urban wage earner. And that is certainly one way to think about inflation, is through that CPI lens. But if you think about inflation through asset prices, you can actually, conceive of a world where inflation has actually been remarkably high over the past, 10, 20, 30, 40 years in a way, because even though the price basket of an urban wage earner has been relatively stable, the valuations of investment portfolios have been remarkably buoyant over the past 40 years or so. And so in a way, that has also been the Fed's playbook, is the wealth effect. And so, when you keep interest rates at levels that realistically are probably lower than where they should be, you get excess growth, but you also get excess equity and bond prices. And that's exactly what we've seen. And so our positioning today remains overweight risk broadly, because that remains the primary playbook of the Fed. And so when we think about fixed income, there is certainly a level of support from monetary policy there. But what's really the beneficiary is the risk side of the equation, the equity side of the equation. And so our view is simply, really over the past, decade and beyond, has been to overweight equity risk. And in the fixed income portfolio, when we think about how to position in fixed income, the question is, what is the objective of the fixed income portion of your portfolio? Is it for liquidity? Is it to manage volatility? And so I think that question is going to be answered by each individual investor. But broadly, in terms of expected return, it's just not getting you to where you want to be. And today there's the added dimension of higher inflation and higher interest rates. And so when we think about the diversification effect of your fixed income, what is that really going to be if inflation becomes the primary risk out there? And so our view is to be underweight fixed income. It's to be underweight duration broadly. And where does that risk go? It has effectively been shifted to the equity side of the ledger. I will say that one of the great debates and one of the big questions that we've been wrestling with over the past decade or two is, if you don't like fixed income, how do you diversify your portfolio away from equity risk? And I think that is the question that investors are really dealing with, broadly. That's one of the primary questions when you think about hedge funds. Our view on hedge funds has evolved fairly dramatically over the past decade or two, and so we have minimized our exposure. I don't know if you want to call them an asset class. It's probably more of a wrapper. It's an economic package. We've largely minimized exposures there. Really a number of years ago. Our view is that on average, and there are sort of some exceptions, they're few and far between, but generally investors have been very disappointed in terms of the returns, the risk-adjusted returns, net of fees that hedge funds have delivered over time. And we can sort of devote a whole segment to that. But maybe we'll just leave it there for now. What we have found is that private equity has actually been both a powerful diversifier, at least on the surface, optically, simply because of the way private equity is valued. But we've actually seen real robust performance from that space as well. But I think the question is, how diversifying is private equity really, when you really think about it? It's highly diversifying from a month-to-month, mark-to-market perspective. But what is it that we're really trying to achieve? If we were to go through a true economic downturn, I really question how diversifying we're going to find our private equity portfolios, especially given today's valuations. And so that really remains, the main question. What we have done is actually increased our allocations to cash and to shorter duration fixed income. Our view is that liquidity is sort of a primary risk in portfolios that need to be managed. And so you can do that through your fixed income. It's shorter duration. It's not going to provide as much downside protection, but it provides you the liquidity that you need during true market dislocations. And it also provides option value, because when the market is down, we risk manage our portfolio. So we build our portfolios based on risk levels as opposed to expected return. And what we find is that approach allows you to have dry powder and the correct mindset when markets are down. And when you have that correct mindset and you have liquidity, you can, those time periods, they really come through, and they can affect your 10-year returns. When you go into these crises, 2008, 2020, you have the right mindset and you have the right liquidity structure in your portfolio.
Yeah, I think that's kind of, I like to think about it like that. Maybe you don't need the long bond, but you can still have some 5-year treasuries in there. You can accomplish a de-risking. You can have liquidity, but you're decreasing your kind of risk to that higher rate scenario, at least in the near term. And given they're very liquid assets, very easy to go reallocate back to the longer end of the curve if the yield curve reprices higher and becomes more attractive. So I guess kudos to being long equities. They've done really well. And again, one of the big questions, of course, is, that we look at many metrics, some of them being things like the CAPE ratios, the PE ratios on equities. And in the US, at least, they look extremely high. Not as high as the dot-com bust, but we're up there north of 30 on the CAPE ratio on the S&P. So I know your firm has been very vocal about rotating into value. That's been a big winner. If you started doing that last year, even the beginning of this year. But like you said, the cycle has accelerated. So many of those names have already done well, and here we sit. And is there still more room to run in value? Should investors be looking towards international equities that have also lagged U.S. equities? We've been saying this for almost, I would say, 5 years that Europe's looks cheap, EM looks cheap relative to the U.S., and the U.S. just keeps driving prices higher and being the outperformer. But is it now time to kind of rotate out of that overweight in the U.S. markets?
Yeah, that's a great question. Our view has been A, overweight equity risk, B, overweight the US. Up until, basically about a year ago, we had tilts towards growth. It's amazing how quickly our views and the tilts in the portfolios have been changing over the past year or two. The thought in terms of the growth tilt, and maybe we can start there. Our view is that the world is changing very, very quickly. Innovation, technological advances, not just in the tech sector, but really across sectors. You're seeing sort of all of the GIC sectors, in a way, they're kind of bifurcating. You've got the communication sector and technology, certainly that are sort of differentiators of the US indices, especially relative to developed market indices. So Europe simply doesn't have the same type of technology sector that we do here in the US. And so that's contributed to, Europe has been cheap for how long? For decades relative to the US. And one of the big reasons is that the way their indices are constructed are just very different than ours. Their indices are weighted much more towards, banks, financials, industrials, whereas we have, the FANG stocks, here in the U.S. Now, you're starting to see, that type of a dominant cohort of technology company arise in China. And we do think that over time, one of our core long-term views is that if we were going to be tilting outside of the US, it's going to be really important as to where those tilts are. Our view in terms of emerging markets, when I was in business school, back in the early 2000s, I remember talking to an emerging markets portfolio manager on the sell side, and she was telling me that, emerging markets, they're a 10-year round trip. And I said, what does that mean? They said, they go up and then 10 years later, they go back down, they're right back where they started. And, it's been this way sort of since the beginning of time with these markets. And, in our view, outside of China and Southeast Asia, that view may still, very well describe the market action outside of emerging markets. Now, to your point, we think in the short term, we are in that cyclical upswing because of the, commodity heavy exposure broadly of emerging markets. And so if you like value stocks, if you are positioned for this recovery trade, emerging markets are likely to perform well as this theme, continues to gain steam. From a longer term secular perspective, our view is that it's difficult to make a living over the long term in the broader emerging markets. Where we think there is tremendous opportunity is in China, both in the rise of these sort of powerful, globally dominant technology companies, but also in the rise of the Chinese consumer. There's significant opportunity in those markets. And so we do have tilts, outside of the US towards China and Southeast Asia. Over, as long as I can remember, our view has been deeply negative on Europe. And I think, and this is despite the relative valuation, the valuation argument. That valuation argument is not new. It's been around, and we've been grappling with it, for a decade at least. But our view is, what is the economic edge? What is the economic argument outside of valuations? I mean, the fact is, horse and carriage companies probably seem cheap on their way down. Now, this is not to say that, Europe is a horse and carriage company. But the fact is, there is just a very, very different mindset. These it's truly sort of a socialist mindset, as opposed to a capitalist mindset. It's very difficult to fire people. It's very difficult to cut through all of the red tape. It's very difficult to grow a company in Europe. And this is in stark contrast here in the US. And so we have had portfolios positioned to reflect that really for as long as I can remember. Now, the question is that changing? And, like this value trade, we do think that there is actually a very strong argument, at least here in the short term, that this may be Europe's time to shine. We think that the vaccine rollout has been very, very different here in the US relative to most of the rest of the world. Maybe the UK, looks similar, but when you look at, Europe, parts of Europe, they remain in, parts of them are in lockdown still. That's going to be changing. And, the vaccine, now that it's effectively, getting to the point where the US is pretty much saturated, we're going to see the rest of the world starting to get the benefits of the vaccine and these reopening trades as well. And so we do think that in the short term, there is a very real opportunity in Europe from a reopening standpoint, from a sort of reflation standpoint. There's effectively an opportunity for a reversion to the mean. But the question is, what's your time frame? And so how overexposed to that theme do you want to be? Because realistically, our view is that at some point before too long, once prices, sort of reach their level in developed international markets, you're probably going to want to be rotating away from those markets, because those long-term secular constraints that those economies are operating under, they're not going to go away. They're not getting any better, we think, either in the short or the long term. So when we think about the US from a valuation perspective, and we've got a couple charts here. So, why don't we, share our screen, and we can take a look at, sort of the valuation measures here in the US. It's hard to argue that things aren't expensive. And so the blue line, so we have the forward PE ratio, price to sales and price to cash flow. And the blue line is the US. And so on a pure, forward-looking PE basis, really expensive. Price to sales, same thing. Price to cash flow, same thing. But the question is this the appropriate way to look at valuations? Because what these charts, what PE charts, price to sales, price to cash flow charts don't show is the level of interest rates. And we think that is a key ingredient to the valuation valuation analysis. And so the charts that we really prefer to focus on are the relative valuations, because when you think about a 60-40 portfolio, what is the main competitor? What is the opportunity cost for investing in equities? Primarily it's bonds. And so the way we think about it is the blue line here, this is the S&P 500 earnings yield. So this is just earnings divided by price. So we can compare yields on an apples to apples basis. And then here is the yield of the U.S. aggregate, which has come up. So about, almost 3.2%. This is as of a couple weeks ago, but the relationships still remain relatively stable. What we think is the key to this chart is not the absolute levels, but the difference between the two. So this is the equity risk premium. And so what we do is in the green line here is we measure that equity risk premium. So you can see back in the late 1990s, the equity risk premium went deeply negative. And so what this meant is that the earnings yield on stocks was very, very low, whereas the yield on bonds was very, very high. So this is a very powerful valuation argument for fixed income. It went much deeper and much further than we thought. I think Alan Greenspan was talking about irrational exuberance here in 1997. And this is always the danger of these valuation studies, is that you don't know how long these relationships are going to persist. But we certainly saw a turn here in the year 2000. What we see today, and so what we've seen really over the past decade, is on a relative valuation standpoint, stocks are very attractive relative to their main competitor, which is fixed income. Now, here we are today, the equity risk premium is about 1.5 points. Now, that's certainly not where we were a decade ago. And so what this tells us is that, stocks are certainly not as attractive as they were back 10 years ago. But the fact is, they are still attractive relative to their main competitor here. And so if you're not in stocks, where are you going to go? And so our view is that despite the fact that absolute valuations look elevated relative to where interest rates are today, stocks are still fairly attractive. Now, the real question is, what happens if interest rates back up another 100 or 200 basis points? Well, that's when this relationship, if you see this 3.16 go to 4.16, 5.16, this changes the equation significantly, and bonds will become much more competitive relative to stocks. The other thing that we have to keep in mind is earnings. And so again, the blue line here is actually right on top of the green line, which is emerging markets. The blue line is the US, and the red line here is EFI. And so we can see here in all of these cases that earnings bottomed out during the COVID crisis, and they are straight up here. And so in a way, you can view this valuation equation as a race between higher earnings on the equity side and higher interest rates that may come about due to inflation fears. And, I think reasonable people can disagree in terms of how they handicap that race. But our view is that an equity overweight continues to be appropriate, although it is not as appropriate as it was certainly a year ago. And so when we think about risk managing portfolios, taking some of that overweight and just moderating that a little bit and sort of managing the equity allocations, we do think that's appropriate really over the next, call it 3 to 6 months, especially ahead of, the potential for higher interest rates and the Fed beginning to drain liquidity from the system.
Yeah, it just seems like a good time to have a little bit of cash on hand for a rainy day, if you will. Well, we've run through equities. We've talked about fixed income. We talked about alternatives a bit. Seems like don't love hedge funds so much, but private equity has been a good place to be. What about private debt, a new market? It's grown to about $1 trillion market. Didn't exist 20 years ago, but another byproduct of the global financial crisis. Much of the lending that was done by banks in the middle markets has now gone to these private funds, these BDCs. Many institutional investors have been diversifying their fixed income portfolios out of liquid fixed income into private credit, private debt to capture that illiquidity premium. Are you guys believers, or is it something that you've avoided?
So it's something that we've avoided, but we can understand why investors may be attracted to this area. I think that the reason why we have avoided private debt broadly relates more to our view on liquidity. And so when we think about liquidity, it is something that we measure very carefully. It's something that we manage very carefully, and we view it as precious. If we are going to go illiquid, we are certainly willing to do so. But our view is that you need to be paid to do so. You can sort of call us a dinosaur. We haven't changed it, but our minimum underwriting standard for illiquid investments is 15% expected returns. And our view is that it is imperative that we keep those types of standard underwriting hurdles on the illiquid side. And when we think about illiquid debt, they simply do not meet those underwriting hurdles, at least without the use of significant leverage. If you have investors that are willing to go deeply illiquid in their investment portfolios, then, all of a sudden call it the 300 basis points or, whatever it is in terms of premium that you can get from going from high yield to what is effectively illiquid high yield, that may be worth it, according to, and I think reasonable people can disagree about this, but our view is that, looking at an 8%, unlevered return simply does not compensate us appropriately for the illiquidity that is associated with those investments. And what we've seen now, our view has actually not always been this way. We were investing in illiquid debt back around 2010, 2011, 2012, in that time frame, because the expected returns on illiquid debt from an unlevered perspective were effectively mid-teens. And what we've seen is over time, as the asset class has evolved and as more money has flowed into the space, that has compressed those expected returns from mid-teens, to basically, mid to high single digits. And our view is that our clients would probably best be served by looking elsewhere for those types of illiquid returns.
Cool. Yeah, I mean, I really think taxes are a big deal for that. If you're a super tax-free entity with a long time horizon like a pension, I think it maybe makes sense for them. And they're the biggest buyers out there, but you throw in the US taxes for the retail investor and your 10 net becomes 5 and for locking your money up. So I think there's a certain spot, certain pools of capital where it makes sense for. I'm a believer, given I'm a fixed income investor, in that illiquidity premium, but to each their own. I guess one last place to talk about is, and it's a hot topic these days, is cryptocurrency. I'm sure you get a lot of questions about it from your investors. Is it the new gold? Am I supposed to be in crypto over gold for that inflation hedge, for the end of fiat currency hedge? I mean, maybe even start with gold. Is that something that you guys have ever believed in or used in your portfolios?
Yeah, so if you start with gold, the short answer is no. We have in the past invested in the miners of gold. And the reason why we would potentially invest in, not necessarily gold miners, but we call it more natural resource oriented equities. And we think the argument for that is that there is an economic return to investing in those types of companies, whether dividend or growth. When you invest in gold, there is no cash flow associated with gold, and so in a way, you can think of gold and you can think of crypto, along the same framework. Is it, what is a store of value? What does that mean? Is that simply a way of a nice way of talking about the greater fool theory? For us, gold, it's a lump of rock. Now, if you can, find companies, that can profit, from, mining that rock or whatever the case may be, that's something that you can actually analyze. Our view with Bitcoin is that, is it the digital gold? It may well be. At this point, it's too early to say for sure. But I would say that the direction that crypto is heading is that I would not be surprised in, 3 years, 5 years, 7 years, whether all of a sudden the question about what is the global reserve currency, is it, does it continue to be the US dollar? Does the US dollar see competition from Europe? I don't know. Does it see competition from renminbi? Possibly. Does it see competition eventually from crypto? Not in the short term, but over the long term, there is a possibility, a growing possibility, that this actually, this becomes the conversation du jour. I think we're still a few years out from that, but I think the possibility of that type of thing happening is growing. Because when you think about the way we here in the United States are effectively debasing our currency If you're a foreign investor and you're truly looking for a store of value, and you know that the next time a recession hits the United States, that they're going to increase the capital stock by another 25% or 40% or 50% because that's the playbook and that's what they do, maybe you want to diversify a bit outside of the US dollar and maybe owning digital currencies as they continue to take hold and it becomes clear that they can't be legislated or regulated away. And I think that is still a question. But if, as over time, as that question gets answered, I think the view on crypto may very well change. But the fact is, if that does happen, you may wind up seeing, crypto go up based on, the pure supply demand argument, because they're not producing, more crypto, certainly in the same way that they're producing more fiat currency. But there is such significant question at this point around the future of these things. I think that, crypto today really remains, I would say sort of a high net worth play. It just has not matured yet to the point, in our view at least, where it is an institutional play. But I think crypto is really interesting in that, it seems to me to be the product of the confluence of a couple different things. Number one, technological innovation. And number two, the speculative excesses that come about through interest rates being held, so close to zero, and all of this free money being created. Sometimes, you think of Dogecoin, right? How does something like this, become valued, where it is? And so when you take fiat currency and you make it so cheap and so free and so easy, that allows these types of new, innovative, speculative assets to really take hold. The interesting thing is that it is possible that, Bitcoin and Dogecoin especially, we look back on them and just see them as the poster child of speculative excess, really as the result of monetary largesse. But it's also possible that we look back and we see it was these very low interest rates combined with this technology that allowed these types of new technologies to really take hold, to take root, and actually grow and become sort of a fundamental part of the conversation, over the next number of decades.
Yeah, it's I've read some books about the old bubbles, the tulip bubble, the great crash of 1929. One day we're going to look back, and these are some very interesting times that we're living in, especially with what's going on in cryptocurrency. Well, Seth, thank you so much for joining us. It's been a pleasure. Thank you for your insights. I think it was a very interesting conversation, and I look forward to seeing you in person again one day.
Thank you, Ken. Really appreciate it.
All right. Okay. Thanks, Seth. Take care.